4 stocks that I own as the largest positions in my private portfolio.
My God! Okay, it's happening!
Yes, in this video, I'm going to share the stocks that I currently own in my private 6-figure portfolio, something I've never done on the channel before. Now, before we do that, I just want to give a huge thank you to all of you subscribers. We're almost 1,500 strong, and I'm so glad to have each and every one of you on the channel. If you're new here, my name's Michael, and I cover stocks, investing, and personal finance on this channel. So if that's something that interests you, consider subscribing and joining our investment community. So last week, when I did my July update on my public portfolio, I said to you guys, if we could get the video to 30 likes, I'd do a reveal of the stock holdings within my private portfolio. So what did you guys do? You smashed that like button over 70 times, making it our most liked video on the channel. So as promised, today I'm going to go over the stocks I hold in my private portfolio. But before we dive into it, I want to provide some context as to my investing framework on how I'm building and managing this portfolio. This way you can understand both the reasoning for picking certain stocks and also my strategy for buying and selling them. For context, I've been invested in the stock market for over 6 years now. In that time, I've been able to grow my portfolio into 6 figures by age 24 through aggressive savings and a style of investing called value investing. Value investing at its core is identifying and investing in undervalued companies and then selling those companies when they're trading at a fair valuation or fair market price. The reason value investing appealed to me as an investor was its emphasis on investing with a margin of safety, a strategy that helps limit the risk of loss while simultaneously increasing long-term returns. However, some limitations with value investing is that it requires a lot of research to find and pick the right companies to invest in, and then patience to wait only until the very best times to buy. Because of this, I don't personally make a large number of investments, and I only invest in opportunities at a price that I believe has significant upside and is where it's unlikely that I'll lose money in the long term. These opportunities might come just a few times a year, and because of that, I don't have a significant number of positions in my portfolio. My ideal portfolio would contain around 5 to 8 large positions that make up the majority of the portfolio, and the remaining percent held by smaller positions. As for my buying and selling strategy, to reduce risk, I typically average down into positions, purchasing only a fraction of the number of shares I intend to own, and then buying more as the price falls further. To maximize after-tax returns, I plan to hold each of my investments for at least 1 year to take advantage and benefit from the long-term capital gains tax rate. In the United States, securities owned for more than a year get a lower tax rate than securities held for less than a year. I'll begin to sell off a position once it's appreciated or raised in price to what I believe is a fair valuation, and I'll completely sell out of a position if the market has priced it above what I think is a fair price. Those are the primary rules that drive my investment decisions. It's a very unemotional, research-intensive, and slow process, but it has helped me receive good returns in the past and limit my long-term losses. So with that all being said, let's jump into the 4 largest portfolio holdings. My largest portfolio holding is actually not a stock, but a mutual fund, VMMXX, or the Vanguard Prime Money Market Fund. This money market fund pays interest and acts very similarly to a savings account, and it's where I keep my investable cash that I eventually want to use to open new stock positions. Currently, it pays a yield of 2.05%, which is better than most online savings banks that are available right now. That's the primary reason why I'm holding my cash position here in the Vanguard Prime Money Market Fund rather than just a savings bank or some other bank. As a value investor, I only want to invest in opportunities where I feel the downside risk is limited and it has significant upside potential. Those opportunities don't come all the time, so having cash on hand ready to invest when those opportunities do arise will allow me to be ready to take advantage of them. Logistically, how this money market fund operates in my portfolio is that any new cash I add to the portfolio immediately gets added to this fund so it can generate interest while I wait to find investment opportunities to deploy it further. Additionally, any dividends that come from the positions that I already own are put into this fund so they can continue collecting interest. Because of the way Vanguard brokerage is set up, dividend reinvestment, at least for me, is not a cost-effective option for individual stocks. This cash in the money market fund is separate from my emergency fund, which is purely just cash used for emergencies or day-to-day life expenses, and this is purely investable cash that I want to invest but currently haven't yet. Personally, I think having some investable cash in your portfolio is always a good idea because it means that if a good opportunity comes, you can at least take some position in it. As I've said before on this channel, if you're always fully invested 100% in stocks, then you'll never have the chance to take advantage of new opportunities as they arise. Now we're on to my largest stock position. If you're new to the channel, this stock might surprise you, but if you've been following the channel for any bit of time now, you probably know what it is. So currently the largest stock position in my portfolio is GameStop, ticker symbol GME. GameStop is an American video game, consumer electronics, and wireless services retailer. They have over 7,000 company-operated stores in the United States, Europe, Australia, and Canada. GameStop was actually one of the first stocks I covered in my 3 Value Stocks I'm Watching series that started back in May. At that time, I discussed how GameStop was a fundamentally undervalued stock that was currently hated by the market. Its share price had tanked over the last 5 years, but at that point was extremely profitable for its price. I'd been looking at it for several months prior and actually ended up opening a position late in March 2018 for an average cost around $13.30. In fact, I actually used the strategy of averaging down in my position on GameStop stock. My first purchase was actually a little above $14. Then, as my luck would have it, the very next day after I made that purchase, a Bank of America analyst by the name of Curtis Nagel downgraded the stock and gave a street low price target of $11 on the stock. So after that report came out, GameStop was down over 10% from its last day close. I found it interesting that the market was giving so much credibility to this report, given that was coming from literally one of the worst analysts on Wall Street. Now, I don't want to roast Curtis too much, but his 44% success rate is statistically way less than that of a coin flip, and he's ranked in the bottom 10% of all analysts on Wall Street. To be honest, I'm kind of surprised he's still got a job, but good for him. Either way, I saw this as a huge market overreaction and was able to double down on my position and bring down my average cost. Now, this has ended up working out quite well in the short term. There have been a couple of catalysts that have helped propel GameStop stock higher, including the possibility of a private buyout of GameStop, which has been undervalued in the public markets. Add to that the fact that when I purchased, GameStop was paying a 12% dividend that was comfortably covered by cash flow. This is an investment that I feel very comfortable with holding for the medium term. Obviously, there are some long-term struggles for GameStop if they fail to adapt to digital games. However, in the meantime, they still produce a lot of cash flow, which is being undervalued in the marketplace. At current prices of $15 per share, do I see more upside in this stock? Absolutely. Am I going to be purchasing more? No. I already have a relatively full position in GameStop stock, meaning I'm not going to want to purchase any more, even if I could. Arguably also, the risk to return was looking a lot better at $13 per share when I bought in near the 5-year lows, rather than now it's increased a bit to $15. My second largest stock position in my private portfolio is actually a stock that I have not mentioned on this channel before, and that's Berkshire Hathaway. Berkshire Hathaway is a huge multinational conglomerate company that provides all types of insurance and reinsurance to companies and individuals, including owning Geico, one of America's largest auto insurers. Using the premiums that come in from these insurance policies, Warren Buffett has been able to invest what's called the float and use this investment to purchase businesses and other companies that produce a significant amount of cash flow for Berkshire Hathaway. I originally initiated a position in this stock last year, back in May of 2017, for around $165 per share. Given that at its core, Berkshire Hathaway is an insurance company, they will benefit significantly from increased interest rates in the future. This is because Warren Buffett and his team will be able to take those premiums and invest them at higher rates of interest or investments with higher rates of return, which will eventually bring in more cash flow to Berkshire Hathaway over time. Another thing to consider with Berkshire Hathaway is that in 2017, the United States was hit with 3 major hurricanes, which caused a significant amount of loss to their bottom line. Not only does Berkshire engage in reinsurance contracts with other insurers, but they also have a significant amount of liability directly through their customers through Geico. Over the past 14 years, Berkshire Hathaway has had an underwriting profit, meaning that they get paid more in premiums than they have to pay out in claims. However, that winning streak came to an end this year as Berkshire Hathaway incurred a $3.2 billion pre-tax loss due to the effect of these hurricanes. While this loss impacted the bottom line when it occurred, in the future, this shouldn't be a huge concern to Berkshire Hathaway shareholders. The reason being is that a catastrophe like this allows Berkshire to increase their premiums going forward in future years. Over time, this should more than recoup the costs incurred from this loss during 2017. Furthermore, Warren Buffett and Berkshire Hathaway are the models for a proper corporate governance and alignment with shareholder values. As a conglomerate, Berkshire Hathaway has many subsidiaries, but each of them has their own independent management team that's able to operate their business without direct input from Warren Buffett himself. This system of management has worked tremendously well for Berkshire Hathaway in the past and will continue working well for the ongoing future. Furthermore, unlike many corporations who declare stock buybacks or other programs to increase share price regardless of what their current valuation is, Warren Buffett has made it clear that he will only repurchase Berkshire Hathaway stock should the stock fall below a set threshold. Now that threshold he has publicly stated is 1.2 times the book value of Berkshire Hathaway. Having a limit on when you'll actually initiate a share buyback based on the company fundamentals makes sure that you're using shareholder capital effectively. It also acts as a kind of built-in insurance when you buy Berkshire Hathaway stock, because you know if the stock price ever falls below that 1.2 times the book value, that Warren Buffett will likely initiate a share buyback and bring prices back up above that level. There are not many stocks that do buyback initiations purely based on market fundamentals, and even fewer that have the ample cash to do that. Berkshire Hathaway is one of them. Berkshire Hathaway is one of the stocks that I'm very comfortable with holding for a long time. Although it currently pays no dividend, the company has a long history of using their shareholders' capital effectively and increasing book value significantly over time. For that reason, this will likely be a core portion of my portfolio for many years. And my fourth largest portfolio holding is actually another stock that I covered back in May, and that's Kroger, ticker symbol KR. Kroger is the second largest grocer in the United States, second only to Walmart. What initially got me interested in Kroger stock was a period of 2 days back in June 2017. The first day was when Kroger cut guidance of what their future earnings would be for the remaining of the year, and the stock immediately took a hit. The next day following that, Amazon announced their acquisition of Whole Foods, which hit grocery stocks across the nation extremely hard. In those 2 days alone, the stock price of Kroger dropped over 25%. Now, as a longtime shopper of Harris Teeter, one of the companies that Kroger owns, my shopping habits and behaviors aren't going to be affected by the acquisition of Whole Foods by Amazon. And even if Amazon was able to cut prices on Whole Foods prices are still so expensive that even if they cut them in half, they still wouldn't be able to compete with Kroger's prices. For this reason, I saw this as a huge overreaction, which is typical with Amazon acquisition announcements. I first initiated a position on the day that Amazon announced the Whole Foods announcement at around $22 per share. I was able to double down on that position a few months later in September when the stock was down another 10%, around $20 per share. Since then, the stock has recovered and I'm currently up on this position. I like the company both as a customer and a shareholder. As with any other information on the internet, don't just buy a stock because someone else did. Always do your own research and due diligence before investing. That being said, if you're interested in seeing my full portfolio and any changes that I make to my portfolio the day they happen, then sign up to my private email list and you'll be the first notified when that becomes available. It's the first link in the description below. Thank you guys for watching, and I will see you all in the next video.